Hi everyone, this is Avnish from AssetPlus, Avnish from the marketing team of AssetPlus, and I'm very glad to kind of welcome you all for this session where you are going to meet your fund managers. To start with the session, I would want to introduce you to Anirudh Naha and Jinesh Gopani. Sorry for the misspelling in the name. So Anirudh, to just give an introduction of Anirudh sir, he is the head of equities at PGIM India, and he manages PGIM India Flexi Cap, Mid Cap, Small Cap, and BAF. He has done his masters in finance and control and has 18 plus years of industry experience in equity and debt market. Now, in his last stint, he was a portfolio manager at Avendus Wealth Management, where he was their head of PMS equity and managed two mandates. Prior to that, he was a fund manager, IDFC Asset Management, and managed an AUM of rupees 1,600 crores across three funds in the diversified and mid-cap space. He has also stints as portfolio manager, Mirai Asset Global Investments Hong Kong, and as fund manager, DSP BlackRock Investment Managers Private Limited. Thank you, Anirudh sir, for joining in. It's kind of glad we are very glad to have you in this session where you'll be interacting with the rest of the people. And I'll also would like to introduce Jinesh Gopani. He has not yet joined, but he's the head of equity at Axis AMC with a rich experience of over 20 years in the capital markets. He joined Axis in 2009 as an equity fund manager and has worked his way up to become the head of equity in 2016. Currently, he manages the flagship Axis long-term equity fund amongst other funds. Prior to Axis AMC, Jinesh was associated with Birla Sun Life AMC as portfolio manager, where he was responsible for alternative asset across growth, value, and dividend basket. He was associated with this company from June 2008 to October 2009. He was also associated with Voyager India Capital as a senior research analyst responsible for BFSI and infrastructure sector, and held a sectorial portfolio manager role for investments. So Balaji, over to you. We'll start with the session and you can take this forward.
No, Mr. Anirudh can start the session.
Oh, sure. So Anirudh sir, I hope you're there.
Okay, perfect. So thank you, ladies and gentlemen. Thank you for this opportunity. So I'll take about 5-10 minutes on the markets and then probably on what we are doing in our funds. See, generally, we were very early into the market. Last year, we had turned cautious because of the uncertainties that we saw in the markets. And we believe the uncertainties continue in spite of the fact that because of good earnings, we've seen a reasonable return, rally in the markets. What we are advising clients very clearly from this point onwards, in fact, for the last 1.5 months, we are saying that the markets are now getting into more expensive territory. Earnings next 2 quarters are going to be weak because commodities, energy, etc. might just not contribute to the extent they had contributed. Globally, inflation is at the peak level that we are seeing. Interest rates are moving up. In fact, we were just looking at the inflation data which came from Germany. It is mind-boggling. And interest rates, hence, to that extent, will have to move up. Globally, historically, it has been seen of central bank governor across the world is recognized by how he fights inflation and not how he fights in recession. Our sense is the fight against inflation will probably continue for some more time, and hence you will see higher interest rates. That is one. Second thing, the problem that we see is globally the world is at the highest level of debt, and hence to that extent one needs to be careful about how debt plays out, frankly speaking. So higher interest rates, higher inflation, highest levels of debt, and these conflicts, etc., the energy crisis which continues. So in all, we would be a little cautious in the near term. Our sense is the problems that are there today, as we see, is completely global. If you ask us, is there any specific India-specific issue? There isn't, absolutely. India is superbly positioned in that sense. One is the balance sheets of corporates are clean. There is no debt. The balance sheet of individuals staying in India, literally very under-leveraged. There is not too much of debt out there. The bank and financials, the lenders, their balance sheets look very good. There isn't an issue. I think the only issue is how the government's balance sheet is, but they have their one-offs. The tax revenues are strong. So to that extent, I think so that is also mitigated. So from a longer term perspective, our belief is India is phenomenally positioned. Over the next 3-5 years, you are going to make a lot of money. But in the near term, next 6 months to 9 months, the world is going to see a lot of challenges. And in such a scenario, when the whole world is seeing so much of challenge, our sense is one needs to be a little cautious, because if the world corrects, say 20% globally, there is no way that India will not correct. India will correct 5-10%. It will correct less, but it will definitely correct. And hence, from that perspective, we believe one needs to be a little cautious on the markets. Over a longer, so our caution basically is one on valuations, and secondly is purely because how the world is positioned itself. So from that perspective, we would be a little cautious in the near term. Now, coming to what we are doing in our portfolios. In our portfolios, we've tried to make our portfolios more domestic oriented or domestic centric to that extent. Look for businesses which are probably getting their raw material, their back end from within India. They are supplying to a huge market like India, where we are not seeing much of a slowdown. So to that extent also, it is positive. There isn't a big shock in demand out there. Anything which is export oriented, we are a little cautious on that. So if you ask us sectorally, how are we positioned? We are overweight, or we have a decent weightage to financials, banking and financials. As I said, the balance sheets are clean, valuations are reasonable, and growth is coming back. We have a reasonable position for capital goods and industrials. We are clearly seeing capex coming back into the system after a very, very long time. The order books are, for the first time, they are sitting on an order book which is at a 5 to 6 year high. So to that extent, last 5-6 years, they have not had this kind of an order book. And a strong order book will invariably lead to, turnover going ahead, and higher margins, higher profitability. So this is another sector where we are positive on. We believe the capital goods and industrial sector is very well positioned. Third sector where we have a reasonably strong weightage is auto and auto ancillary. Again, domestic oriented. The demand, we think, will do really well. If you think of it, when I look at auto and auto ancillary, last 3-4 years, they've had a lot of issues. BS3 to BS4 transition, BS4 to BS6 transition. COVID came, demand actually collapsed. Crude oil prices have gone through the roof. GST taxation is high. Semiconductor availability was an issue. All this is going to ease out in the next 3 to 4 years. And hence, from that perspective, we believe auto and auto ancillary, which is specifically catering to domestic or inward looking demand, should do reasonably well. So this is another sector where we are reasonably positive. We are also positive on consumer discretionary. And by that, we mean anything where people don't need to buy it, but they go ahead and buy it because they have the incomes. This is the first time after 2 years where the festive season is going to be completely opened up. And hence, we believe there is going to be a decent amount of consumer spending that will happen. And to that extent, hence, we are positive on apparels, footwear, consumption. You think of any name or any segment which is discretionary in nature, we are positive there. What are we underweight and what are we conservative on? I think IT is a segment where there is still some amount of uncertainty left, given where the globe is. So can the stocks correct 10-15%? I think so. Valuation correction can happen there. So that is something that we are a little conservative on. The other sector where we are playing it as a proxy cash, and we believe that probably growth might be not as fast as what the overall market could be, is pharma. There are challenges out there, especially if it is export oriented pharma into the US. I think the FDA challenges, etc., might be there. And hence, to that extent, we are playing pharma as proxy cash. If we get a good business, good idea, we will sell pharma and buy into that. And the last place where we are conservative is consumer staples, purely from a valuations perspective. We think the valuations are expensive, and hence it doesn't leave too much of an upside for investors. So let me summarize. I think so The next 3-6 months, we would be cautious. What we are asking investors to do is spread out your investments over the next 6-9 months. That will probably help you navigate the volatility and stay invested for the next 3-5 years. We believe there is a lot of returns which will be made in the Indian equity markets in the next 3, 5, 10 years. But near term, can the markets correct 5-10%? I think so. That is a reasonable assumption to be kept at the back of your mind. So near term conservative or cautious. Over a longer period of time, we are extremely positive on the Indian markets.
Great, Anirudh. Thanks for this update. So here we have around 2,500 partners who have been empaneled with us, and there are some questions from some set of partners that how is the performance is going to be in the coming future. There is some concern on the PGM FlexiCap performance, because there's partners who have been selling PGM FlexiCap, seeing the performance and the portfolio for a very long time. Can you brief?
Let me address the performance on FlexiCap. So see, the FlexiCap, if you look at it on a longer period of time, 3 year, 5 year, we have done reasonably well. I think the last 1 year has been challenging, because last 1 year there was an event where which was unpredictable in that nature. So that was the conflict between Russia and Ukraine. Because Russia and Ukraine, the conflict happened, all of a sudden, commodities and energies did exceedingly well. Okay. Now, commodities and energy has a reasonably strong weightage, a big weightage in the benchmark. We don't usually play cyclicals, and hence we were literally zero on energy and very low on commodities. So we didn't participate on that, and that happened, and it was a binary event. It immediately played out. So to that extent, we couldn't participate, and hence we got impacted. There was another reason. See, we were heavy on segments like cement, etc. We believe cement will do reasonably well over the next 3-5 years. But all the raw materials which went through the roof, commodities and energy, they feed into the cement as a raw material. So the cost of raw material went up and cement corrected dramatically. So it was a double whammy for us on both sides. Today, if you look at it, commodities are correcting, crude is correcting. So we have all started coming back. In the near term, we don't talk, of course, of the near-term performance. But if you start looking at our near term, it has started coming back. There is another reason. See, we've always said we will be a true FlexiCap. So at any point of time, you will have about 15 to 20% small caps. Now, if you look at where the small cap index is, it is still below, about 10% below the highs, previous highs. Whereas mid and large caps have all come back to the previous highs. So to that extent, 20% of the portfolio is still not back to its potential. So if you ask us, I think a large part of the pain in FlexiCap is over, and we are not concerned at all. I think as long as we run it judiciously, if we and well thought out, without playing too much of commodities and the cyclical part, we should do reasonably well. So today, as we speak, the FlexiCap has about 57-58% large caps, and about 34-35% mid and small caps. Please understand, if the markets correct dramatically, because we have about 15-20% small caps, we might get impacted. There could be some volatility, but over the long term, we are extremely positive on mid caps and small caps, and hence over the longer period, I think the fund should do reasonably well.
Great, thanks. Dear partners, if you have any question, we have enabled the access to unmute, so you can unmute and ask. So now we have one question from Mr. Satish from Chennai.
Hi, Anirudh.
Yeah, hi, Satish.
Hi, I'm a great fan of PGIM Flexi when it comes to 5-year return. It has really delivered the mandate, and it's been a top 3 funds always. Yeah, you have addressed about the last 1 year, but I'd like to understand, you are overweight on banks, automobile ancillaries. Why these 2 sectors? I understand financial services. Can you throw some light to why you are overweight on these 2 sectors? What are the prospects for next 2 to 3 years, kind of?
So see, banks and financials has underperformed till December 21st. December of 2021. Last 3 years, it didn't perform. Today, when I look at the financials, a large part of the asset quality issues are resolved. Growth has started coming back. banks have been raised capital also, so they are very well capitalized. Okay, and valuations are very reasonable vis-a-vis where the rest of the sector is. Even today, you get banks which are below 1 time price to book. Okay, so from that perspective, you've got a sector which is now a large part of the asset quality is done. It is well capitalized for growth. Growth is coming back, and valuations are reasonable. So from that perspective, we remain positive on financials. Similar for auto and auto ancillary, the reason I said is clearly last 3-4 years were very challenging. You know, all the capex they did, they went through COVID, demand collapsed, crude oil went through the roof, semiconductor issue was an availability was an issue, EV penetration was an issue. So I think so there was a lot of on ground challenges and stories which were going around, which were perceived to be challenges. I think the next 3-4 years, the auto and auto ancillary segment will do reasonably well vis-a-vis where they are positioned. So to that extent, we are positive on that.
Thank you.
Welcome.
Partners, we have another 5 minutes only with Mr. Anirudh. So if you have any questions, you can unmute yourself and you can ask, or you can post in chat also.
Anirudh, this is Harmat.
Yeah, hi.
Hi. So my simple question is PGIM flexi cap is, I have had allocation of both PGIM flexi cap and PGIM mid cap. Ironically, flexi cap is considered to be the more cautioned kind of an funding among
Right.
funds, and mid cap is considered to be the little higher risk fund, right? But
Right.
ironically, the situation is that PGIM since last 1 year, if I take January to till date, right?
Right.
So unfortunately, this is a very funny story for me, that mid cap is 7.5 to 8% positive vis-a-vis flexi cap, which is negative in the tunes of about 8 to 10%, right? If I talk about 3 to 4% negative as far as January 22 till date, right? So how it comes to, because if we say there are, as you say, there is some part which is a small cap, and
Right.
there is a major part which is about 60%, 57 to 58%, as you said, is in large cap. But if we see that Nifty large caps have performed well in last 3.5 months compared to their peers, or against that even small cap indices. So indices are minus, but there are certain small cap
So
funds who are
I got
doing
your question. See, I'll tell you frankly
better.
speaking, this index has a lot of commodities. The benchmark had a lot of commodities and this thing. Where we were not there, we were very heavy on cement, etc., which were the end consumers. And those segments actually fell very, very dramatically. If you look at it, cement, without naming any this thing, if you go through the names or the kind of correction in mid and small cap cement that had happened, it was very deep. Okay, so that is one. Secondly, is we had about a 2% to 2.5% overweight on IT. And in the month of June itself, IT fell by almost 28-30%. So the benchmark fell less, we fell more. 30% correction on 2.5%, you can understand, in 1 month was a big contributor to negative. So let me put it this way. See, in hindsight, if you just go back and do a portfolio attribution, you can easily see the reasons why we have underperformed. And we have touched upon all of them. Today, if you ask me, all those concerns are more or less addressed. If you take a look at, let's say, the last 1 month, 3-month return also, we have started coming back. There is absolutely no doubt on that. The only question is, when will the 1 year start looking better? Give me 6 months time. I don't think you should be really worried about it in that sense.
Fine. So what kind of question? Second question is, what kind of changes you have did in your portfolio?
So basically, we went overweight financials and we went underweight IT. And other than that, we frankly haven't done anything. Commodities have started coming off themselves. And we have an overweight on auto and auto ancillary also. So if the festive season is good and India does well, we should be reasonably strong in our performance.
So I was just going through your, right now with money control. So I am a bit surprised that though you said you are heavy on auto and auto ancillaries, in your top 10 holding, I found only one company which is into auto and auto, and this is Mahindra and Mahindra Limited. Rest you are high on ICICI Bank, HDFC Access,
So
Cholamandalam.
see, boss, I know my portfolio. So let me put it this way: if you go through the full portfolio, you will find a reasonable overweight in auto and auto ancillary. I will not take individual names, etc. What I am doing exactly now, but you will find a reasonable overweight position on auto and auto ancillary. You can be assured about it. I don't know which
Fine.
fact sheet you're looking at, but please wait for this month's fact sheet. I think so. You will see that.
Fine, not an issue.
Hello.
Yeah.
Okay. Thank you.
Hello.
Yeah, we will
Hi.
take last call with Anirudh because 5:30 he needs to join for another meeting.
Okay.
Any participants?
Good evening, sir. Ashutosh here.
Yeah, hi. Good
Uh,
evening.
I would like to question, Abhijo technical, I'm not asking. What the non-financial characteristics you examine in a company?
Sorry?
What are the non-financial characteristics you find in a company for your portfolio?
No, so see, non-financial, what we look for is, the history of corporate governance of that company. That is one of our parameters for selecting a business. We look back into the history of how promoters have driven their business, etc. A reflection of how a company has been run or what is the corporate governance of a company is in the history of the numbers itself, frankly speaking. So to that extent, we do a lot of digging into the corporate governance part of the company, and we take it forward from there.
Thank you.
Great. Thanks, Anirudh. Thanks for joining us. Still, dear
Sure.
partners, PGM FlexiCap is still there in our recommendation list. We have not removed it. Still, we are there with PGM, and I think by the next 6 months is what the turnaround is. Anirudh is telling. I believe that it will happen. Thanks for joining, Anirudh.
Sure. Thank you very much. Thanks for having me.
Dear partners, please be in the line. We have next the Access CIO also to give us on their update on the fund house. Avnish, as Mr. Jignesh joined.
Yes, so Jinesh has joined. I hope Jinesh, you can hear me.
Yeah. Hi guys, I can hear you well.
Great. So, Balaji, I'll just take a minute to again, throw some light on his profile. So everyone, Jinesh is the head of equity at Access AMC. And like I said earlier in the brief, he is currently managing the flagship Access long-term equity fund among other funds, and has over 20 plus years of experience in the capital markets. So Jinesh, over to you to take this forward.
Yeah. Good evening, friends. If I can just, if you can help me just understand what you want me to
Jinesh, so this is
address
Balaji.
upon.
Jinesh, hi, this is Balaji from AssetPlus. So what we have planned, we have all our partners pan-India in this platform. So earlier, Anirudh from PGM has just given a brief update of how the market has been done and how the positioning of his fund is there. And we had some concerns on the performance catch up in the fund for last 1 year returns.
Sure.
So similarly with Access also, we would like to hear a few minutes on the market and how the fund has been positioned in terms of the cash call or in terms of the sectoral update. From there, partners will take 5 minutes on the Q&A.
Sure. So first I would just like to highlight our philosophy so that we are all in same page in terms of what Access is known for, and also how we have tried to navigate different cycles of the market with steady and consistent return over a longer period of time. So friends, thank you for having me on this call. First, I would just like to highlight our philosophy so that we are all on same page. So clearly, as you guys know, you would have gone through our fact sheet, the portfolio constructions, and the way we have invested in some of the stories for a longer period of time. We have a very simple and very clean philosophy of growth. We feel that India is a destination for growth, and wherever the earnings growth will come, wherever the profit pools will come, at the end of the day, the money flow will be to those companies only. FIIs are also looking India as a growth destination and not a value destination. So for us, we feel that growth is the way to look forward in terms of prosperity, in terms of wealth creation. And that is what we have seen, at least in my experience, I have seen over the last 20-21 years, that if you are able to pick and choose those wealth creators, then there is a lot of opportunity to create steady and consistent returns. So growth is our philosophy. We look for companies in the sector which are scalable in nature. We look for corporate governance of the company. The pedigree of the management is very, very important for us from the research point of view. And ultimately, everything boils down to ROE, cash flows in sync with growth. So a company at a higher valuation without any growth or ROE, I think that is not the way we invest. We really look for companies who are growing than industry averages, higher than industry averages, and are in a position to have a sort of a leadership kind of a role in that sector, or a probable leader in that sector. And also at the end of the day, with the innovation, with the new way of doing business, they are able to generate higher ROEs and the cash flow as compared to their peers. So that is how we look at creating our universe, which is, as of now, our universe of stocks is around 300 stocks, and we are invested in 180 to 190 companies for a AUM of 1,50,000 crores. So that is the way we filter our stories. Our simple motive is avoid mistakes in the portfolio. Rest all the portfolio stocks will take care of returns over a longer period of time. So this is how the philosophy works across our funds, except for value fund, where obviously the definition is value. So we have to look at the different way of looking into that. And that is how we have created the portfolio, and that is how we have created a size of around 1,50,000 crores over a period of last 13 years, 14 in running. Coming to markets, clearly for us, we have done a scenario analysis, and for India, what is positive and negative based on that scenario analysis. So clearly, oil, inflation, and currency are critical metrics to look for if you want to play India. Oil below $100, inflation can be controlled, currency is stable. I think we are in a very good state, and that is what the scenario is panning out as of now. 3 months back, oil was around $130, $125. So oil between $100 to $120, $125, I think India can still manage growth, but there will be some shave off in terms of growth given the pressure on inflation and the currency, which can get depreciated faster if oil is higher. Oil above $140 or $135 for a longer period of time, India will be in a very, very bad shape, I would say. Not bad shape, but India will struggle, because then the impact on the fiscal deficit side, trade deficit, and ultimately passing on higher oil prices to the consumer will lead to higher inflation, which is not what you want as an Indian citizen. So these are the three scenario analysis, keeping in mind global factors. So as of now, oil below $100 is a good sign. Inflation is hopefully under control. Government has been in a position to manage the oil prices at the ground level, which is keeping the momentum of the businesses alive. So there is reasonable momentum in the market despite so much gloom and doom in the world. And I think that is what is making India as an oasis because of the not so good stories around the world. US is slowing down. China is slowing down. US slowing down will also impact China, because China is the largest trade partner with US. So all in all, I would say India at this juncture with the scenario analysis looks to be in a very good state. And so it is good to play domestic consumption stories, be it financials, be it auto ancillaries, be it consumption basket, and also be it capex led proxies, which is building material and so on and so forth. Because US is slowing down to some extent, and we don't know whether it will move into recession, I think it is wise to be underweight on IT. That is what we are as of now, and that is how the construct of the portfolio is. That the financials are heavy, consumption is heavy, and also autos and auto ancillaries, and anything linked to proxies to capex story or a housing story. So that is how the construct of the portfolio is. Just to harp on the performance, clearly, as you would see, as I have articulated our philosophy, last 2.5 years was for value and momentum, where where commodity stocks, metal stocks did very well, and rightly so, because it is always a cycle. For us, 2013, 2016, and last 2 years have been bad in last 13 years of history, because there is a cycle style change which happens, and normally over a period of time the style changes again come back, and that is when we do start doing well. Also, one more point of view is, because we are into good quality, high quality companies which are even owned by FIIs. If you take out last 2 months, I think there was a relentless sell-off of FIIs to the close of $40 billion in last 12 to 18 months period, and that is why, despite companies doing well, there was pressure in the market. Now that you are seeing reversal of flows, we have seen smart recoveries in most of our stories, and July was the first month to look into, and also August and September are reasonably okay. Having said that, obviously there is going to be volatility in the market because of many factors which are not in our control, but from a company's perspective, I think we are in very good shape in terms of companies executing on ground. Last quarter, if you really see, was the first quarter of I would say uninterrupted businesses on ground, and we have seen our companies where we are invested heavily have executed very well, and most of them are above pre-COVID levels in terms of growth rate. Most of them have been able to garner higher market share in last 2 years, and now raring to go in terms of growing further. So in a nutshell, as I said, style preferences has what has led to underperformance. We are not a high beta player, and hence when momentum and the value, so-called value, does well, we don't do that great. But as the style changes again, we come back into our winning position, as we have started seeing now in July, and now even in August and September to go for. Obviously, it's a very short period of time, but that is how we have seen the cycles moving and changing, and we are reasonably confident that if the scenario plays out well, where India does well in the given oil prices, I think the economic momentum of 6.5% growth and inflation of 6% should bode well from the growth stories point of view, where companies can grow at 1.5x or 2x of GDP, and our companies take the market share from the other players and try to have a better cash flows and ROEs given their leadership position. So this is what I would like to say. Any questions or any queries, happy to answer. Thank you.
Thanks. So partners, you can unmute yourself and you can ask if there are any questions, or you can post in chat also.
So, sir, this is again Hermet Market, right?
Yeah.
My particular question would relate to two of your funds. One is Axis Focus 25.
Yeah.
And another would be Axis Growth Opportunities.
Correct.
Now, if I see since last 1 year, if I consider last 1 year, post 2021, the Axis 25 had performed 1 month, I mean 3 months. It has shown a good return. But if I take an average of the category, right, then the situation is that they have highly underperformed.
Right? Yeah, correct. You are absolutely right.
Category.
You are absolutely right. That is what I was just trying to say.
Yeah. Yeah, I know this, sir. The question is not on that, but I just wanted to know what are the corrective action as a fund, because see, 1 year is a very long time. It's almost there's
No,
9
no,
months
sir,
going on.
sir, I would tell you, it is not a corrective action which is required. It is the style. Once the growth style comes back, I think, as I was just trying to tell you, that once FII reversal happens to these high quality companies, once growth comes back, basically, see, ultimately, sir, uh, uh, if you really see, markets are slaves to earnings growth, right? Last 2 years, you would have seen, because commodity is doing well, commodity numbers were coming good, right? Because of the base effect, and they have not done well in 2018, 19, 20. So they all did well in terms of profit pools. Now, again, when you see the construct of the economy, the profit pools will shift to growth stories. If, again, as I said, the scenario analysis plays out as per our expectation. So if profit pools again goes back to growth stories, and where we are very well placed, I think we don't have any reason to believe that why the stocks will not perform, or in terms of generating returns what they have done prior to 2020 for many years. So the corrective actions, I would say, are not much. Maybe we could have trimmed in the start of the COVID, which we should have trimmed, I think, financials a bit. We should have added, let's say, some stories which we normally don't play in our portfolios, but we could have added 5-10% of the portfolio there. But obviously, in hindsight, we can say this. But obviously, if you can understand the our philosophy runs so deep in our research analysis, that we don't try to change just because of the underperformances for last 1 year or 2 year period. See, we are looking at a product with 5 to 10 year period in terms of longevity, and also we invest in companies where we can reasonably assume good opportunity to make money over a 3 to 5 year period. So we just held on to our stories what we liked, and now you are, hopefully you will benefit out of it.
That's okay, sir. But the only thing where I found little anxious on this, that if you see that till if I see your full performance, it is as you said, it is minus. But what happened in last, I mean, like if I see the 3 month performance, right, it is 16.77% on a positive side. So it means that you must have made certain changes which led to the, because earlier it used to be 20, almost 17-18% minus. When if I talk about before the 3 months of time, and
You are
suddenly
talking
now,
finance sector, right?
yeah, no, I'm not talking about finance. I'm
You
talking
should.
about overall performance of the fund, sir. See,
Yeah.
my question is very, very clear and crisp. It's only on the data which I have. Data
Yeah.
says your 3 month performance is, you are positive in absolute terms, 16.77% compared to your last, I mean, like 1 year, 2 year growth, right? If I talk 2 year, it is 40% positive. But if I say 1 year, it is minus 12.04%. So it
Correct.
means that you must have made certain changes, because it is not that suddenly that.
Certainly, as I said in my opening comment, that we have trimmed down on technology, we have added auto, we have added more of financials, we have added some of the proxies to building material or housing stories. So obviously, you would see that in the portfolio really seen. So we have added Asian Paints in a big way, we have added Maruti in a big way, we have added Torrent Power in a big way, we have added we have added Apollo Hospital, PI Industries, which is one of the great export agro stories. So we have done the changes wherever required, but that is the normal part of the process. We have not done because last 2 years are bad and you want to do something, right? It is more about understanding where the profit pools are going and if we can be part of that. Hello.
Hello.
Hello. Yeah.
Yeah, are you getting my voice properly? Because I missed a little part of it because of this network issue. So you want to say that this you have did as your regular practice, and because of that, where you have dropped down certain of the stocks, and what you have added, because of that, you were able to
Correct.
gain, right?
Because of the changing scenario. Because see, I told you the scenario analysis, right? Because see, let's say if
Mm.
oil goes to 140, 150, I think again we'll have to go back to defensives, which is pharma and IT. Because
Mm.
India then will look pretty bad as compared to the global world. But if oil remains below $100, then I think India is in very good shape in terms of keeping the momentum going.
Okay. Now the second question is related to your growth opportunities,
Yeah,
right? I know that there are certain this holds a certain foreign equities as well, right?
yeah,
This specific fund holds a foreign equity. But
correct.
considering what would be your suggestion? Because see, the US markets, especially because the major holding in Access Growth Opportunities Fund are, I mean, like if I talk about foreign participants, they are basically, all big companies like Microsoft, Alphabet, and Amazons of the world. Now,
Correct.
my question is currently US is not doing good at all, right? And looking to your current allocation to foreign equity, as a fund manager, what should I do? I mean, like, where should I move out of that and put it into mid cap stories currently, or a large cap stories? Because as such, Axis Blue Chip has not delivered much of the returns. Or should I keep it into a balance advantage kind of a portfolio, which will curb the little bit of volatility, because of this foreign equity, the entire fund performance is getting butchered.
No,
Though
but
the
see, what I would suggest is, and again, please take at least 2 to 3 year view rather than taking a very short term view, because
Hmm.
markets can change pretty quickly. And if let's say suddenly inflation comes down in US and US just touches recession, people have
Hmm.
started talking that in next 12 months there will be rate cuts in US. So
Hmm.
what I'm just trying to say is, don't get into that mode that I will shift from this to that for 6 months period, because it can, see, it is very difficult to time the market. We also don't time the market. What I would
Hmm.
suggest, irrespective of the foreign thing, you are generating good returns from Axis Growth Opportunities. As of now, the exposure to foreign is 17% because, as you
Yes.
know, the SEBI is not SEBI, and the other regulator is not allowing more participation. So
Hmm.
fortunately, it was good that we bought more into domestic equities, because we are taking money but not investing into foreign portfolios. So in a way, it
Hmm.
is good. And of that, if you really do the construct, 16 to 17% of that, 60% is in US, balance is in other rest of the geography. So technically, you are just I would say 11 to 12% in US. So I think
Hmm.
that much risk, I think one can take. I think, because when the swings will reverse, it will reverse,
Hmm.
and it will become very difficult for you to again shift from this to that. So what I would generally request, the any which ways, 85% of your portfolio or 84% of the portfolio is domestic, right? And you are playing mid cap stories there. So you are
Hmm.
not losing out in anything.
Hmm.
Obviously, when, uh, 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 for a shorter period of time, maybe the global market might not do that great, but it
Hmm.
is still that, let's say, just 16% of the portfolio, right? So it is nothing to majorly lose, unless you think that Nasdaq is going to half from here, which we don't feel, because any which ways the valuations have come down dramatically down. And in fact,
Hmm.
in next 12 months, people are talking about interest rate cut happening, because once this inflation issues goes away, there could be a possibility that US might touch just recession and then again start showing growth. So what I would, this is my personal view, and again, if you ask me, I have not removed my money.
Hmm.
I think from a portfolio construct, we are heavily into domestic. In the domestic, we are heavily into mid caps as any which ways. So So I think you are not losing out anything just because 10% of your or 12% of the portfolio is US. Hello.
Harmit, you're there?
Yeah.
Yeah.
Yeah. So, okay. So, as you said that there would be an issue as far as this, I mean, like, as you say. So, because see, we had recently we had a discussion 2 minutes back before you joined with some other fund manager, and his view is that interest rates are going to hike.
See, that is
And
all in the price, sir. That is all in the price. Now already US 10-year is 3.5 now. So that is already baked in. Nothing new is there.
I mean,
People
like,
know
what
that.
should as a distributor, if you understand, it is very confusing that one side, one fund manager says that no,
I
there will be a
understand.
hike
See,
in.
frankly, sir, frankly, I would say nobody has any view, frankly speaking, because it is too volatile. It is too volatile. You don't know what is going to happen tomorrow, because every day there are so many changes happening. Every day means there is some or the other data point which is very, very volatile. Means oil also, if you would have seen,
Yes.
2 months back, you would have never thought that you would see $89 or $90, right? So
Yes, perfectly right.
things are happening very fast. Nobody has any view. Just because you are asking us the view, we are giving you the view for global market.
So
Yes, I think,
ideally, in such a situation, what out of my experience, what
Just
I
stay
feel
put,
is,
sir. Stay put.
yeah,
Just stay put. Don't do anything.
yeah.
I will tell you, because sir, you will make mistakes everywhere.
Jinesh, I think this suffices the answer. Harmit, I think
Yeah,
we
yeah,
can speak with the Access product team so that you can have
yeah,
even clarity on how they have been
yeah,
managing.
yeah,
See, if you see Axis as a AMC from 2016 to 2020, 21, there was a very strong performance which has been driven. And I believe that it will continue in the coming years also. Maybe there's a temporary 6 months or 8 months lag which has been seen. So I think Jinesh has well answered that. So partners, if there are any other questions, please feel free to unmute yourself and ask.
So, Balaji, if you allow me to ask me one more question, just one question.
Yeah, Harmit, just 1 minute. Someone has raised the answer.
Sure, please.
Hi, this is Satish here. I'm an MFD with AssetPlus.
Yeah, hi.
This is with regards to Axis Focus 25 fund.
Yeah.
Yeah, if you look at the last 1 year performance, I'm just talking about 1 year performance alone. If you look at it, it is a negative 12%.
Yeah.
See, I understand Axis follows growth and quality kind of stocks, but when the market recovered and to minus 12%, I have two queries on this particular question. Number one part is that any recovery or any particular strategy if in the near term, which is next 6 months to 1 year, anything in particular that you guys are planning anything? And second part is that how about the fund performance going forward? Which sector you'll be overweight, and what is you are strategically planning for next 3 to 5 years kind of stuff?
Correct. See, we are bottom-up stock pickers, so we would like to find out companies from each and every sector, and which is the best story in our universe, given by our research analysts. That is our basic motto, and I have articulated you the philosophy what we run. Based on that, we come out with top 25 ideas, which are best ideas we feel which will be good for the investors from a 3 to 5 year period, taking into account the calibrated risk you take for investing into some of these companies. See, there are many companies which are momentum driven, where people don't even ask about valuation, where we also know stocks will go up, but because the judicious research approach and the responsibility of investing into good quality companies, we restrict ourselves participating into those momentum trades and high beta trades. And that is why, if you see, I was just alluding earlier to earlier question also, that Hence, the performance has not been great because the style has not performed in last 2 years period. Having said that, if you see as sir said, that if you see 17, 18, 19, 20, when growth was doing very well, we were like doing very well from the portfolio perspective, and the stocks were more or less similar to what they are now. So there is not significant changes except for the strategy. What we feel that in the current scenario, as I said, if the oil prices remain below $100, I think India specific stories should do very well, and some bit of exports, not the technology led exports, but more to do with specialty chemical type companies, which is where there is a story, or where there is a theme of China plus one story, and now people are talking about Europe plus one story, which can emerge for a company which is mid cap and can do very well over a 3 to 5 year period. So that is how we are strategizing this portfolio. As I said, that last quarter was the first quarter of uninterrupted business in India, and we have seen most of our large holdings executing very well on the ground, and we have seen the stock prices also moving nicely. So if this scenario holds for next 6 to 9 months period, I think we should be in a very good shape. Unless again the risk is, if let's say suddenly oil prices start rising and oil goes to $120, $130, then I think clearly we'll have to again re-strategize because of the pain which will have in the Indian economy because of the rising oil prices. I think at this juncture, we are very well placed in terms of stocks which we are owning, and we would like to, deliver good returns, hopefully, if all goes well. Hello.
So you had some other question, Mohammed?
Yeah. So
Last,
the last question, yeah. The only question which I have, as you said earlier also, that currently the market dynamics are such that it is changing very rapidly, right? Very rapidly. That one day is some, second day is something. So in such a case, what would be an ideal strategy for our customers who have not seen, those who have come in 2000 late 21 or somewhere in 22? What would be the ideal strategy for them? Because the thing is, like they have not seen profits since last 1 year, right?
No, I think the biggest problem with India is that people go only when Sensex or Nifty hits highs. That is the biggest problem we have seen, and people will not invest when there are downturns in the market. My view would be either go for SIP route and keep investing, so that and I think 2 year is a very small year if person is investing with at least 5 to 10 year view. So I think there is no point in doing anything. Just stay put. I think if our scenario goes well, then I think next 2 years will be very good for India. And I think even if the investors have not made money in the short term, I think they will benefit if they remain invested rather than switching, rather than redeeming and trying to time the market.
No, I'm not asking from that point of view. What I'm asking is, this is what we have already discussed. What I'm asking is, what could be a portfolio construct, say, would be ideal. The reason is, should somebody, because the high volatility would remain till what I'm understanding, right? If I'm under the next 3 to 6 months, again the volatility would be very high, right?
Correct.
Considering the situations which are there. So if somebody is heavily, say 89 to 90% is into equity stand, should one curb down his equity exposure about 30-35% into a balance advantage kind of portfolio, so that it can hedge a little for the such kind of volatility and curb their equity investment?
That depends on the risk appetite of that investor. If he is invested in 2021 with 90% of portfolio in equity, I think this is not the time to get out, I would say.
Okay.
If he has taken risk in 2021 that markets are going to go up, I don't think this is the time he should be looking at switching to balance type of funds, where any
Mhm.
which ways he has seen the pain, right? You
Yeah.
have already seen the pain of COVID and everything. So now it is
Mhm.
time to reap the benefits out of it. So I think I would suggest, again, it depends on the risk appetite of the investor, what he has invested in 2021. If his risk appetite has gone down, then obviously shifting is better. But if risk appetite is remaining and if he is taking those next 2-3 year calls, then I think he should not be doing anything. Just stay put and invest more.
Fine. Okay.
See, whatever said and done, markets are still at 18,000 levels, right? So
Yeah.
much volatility. So markets are climbing all this wall of worries. So, means, see, frankly, because we are seeing shorter periods of time, we feel volatility is very high. But when you stretch it to 2-3 year period or 5 year period, then that volatility will not impact your returns.
Okay. So the ideal
If
situation
you
is
take,
for
if you take any 3 year, 5 year period for the market would have given you positive returns only, right?
right. That's true.
Yeah. So I
But, you
think
know,
you just have to remain invested. That's it.
that's it. Okay. Okay. Thank you.
Yeah. Thank you.
Thanks, Jinesh, for joining with us and basically answering.
Thank
our
you. Thank
questions.
you, guys. Thank you. Thank you very much.
Thank you, partners, for joining. We'll meet again with different session next week. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.